Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is June 6th, 2025, and we're diving into ABM's fiscal second quarter 2025 earnings report. ABM, a leading provider of facility solutions, has just released their latest financial results. Joining us today is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. It's a pleasure to discuss ABM's performance and what it means for investors.
Revenue and profitability overview. Let's start with the top line. ABM reported a revenue of $2.1 billion for the second quarter, marking a 4.6% increase from the previous year. John, can you elaborate on the factors driving this growth?
Absolutely. The revenue growth was primarily driven by a 3.8% organic increase, with significant contributions from the business and industry and manufacturing and distribution segments. Despite some unfavorable timing in technical solutions, ABM managed to secure $1.1 billion in new bookings, which is an 11% increase year over year.
And what about profitability?
Net income for the quarter was $42.2 million, slightly down from $43.8 million last year, mainly due to higher interest expenses and transformation costs. However, adjusted net income rose to $54.1 million, with an adjusted EPS of 86, reflecting improved segment earnings and lower corporate costs.
EPS forecast and analyst expectations. Analysts had forecasted an EPS of 87 cents for this quarter. How did ABM's actual performance compare?
ABM reported an adjusted EPS of 86 cents, just shy of the forecast by 1 cent. This slight miss can be attributed to higher interest expenses and transformation costs, which impacted the bottom line despite strong revenue growth.
With 4 analysts covering the stock, how significant is this miss?
While the miss is minor, it highlights the challenges ABM faces with rising costs. However, the company's reaffirmed full-year EPS outlook suggests confidence in overcoming these hurdles in the coming quarters.
Operational efficiencies and future outlook. John, let's talk about operational efficiencies. How is ABM managing its operations to drive profitability?
ABM's adjusted EBITDA increased to $125.9 million, reflecting strong operational performance. The company has made significant strides in deploying its ERP system, which has improved cash flow by $138.5 million sequentially. This is a clear indicator of enhanced operational efficiencies.
Looking ahead, what is ABM's outlook for the rest of the year?
ABM has reaffirmed its full-year adjusted EPS outlook of $3.65 to $3.80, indicating confidence in its core markets, particularly in high-quality office buildings and manufacturing facilities. The company expects delayed projects to materialize in the third quarter, which should support continued growth.
CEO insights and strategic initiatives. What insights did CEO Scott Salmirs provide regarding ABM's strategic direction?
Scott Salmirs highlighted the return to organic revenue growth in key segments and the strength of ABM's market position. The company secured $1.1 billion in new bookings, underscoring its focus on innovation and its role as a resilient service provider. Salmirs also emphasized the importance of the ERP system in driving future efficiencies.
How does this align with ABM's long-term strategy?
ABM is committed to creating smarter, more connected spaces, investing in technologies that enhance facilities and empower clients. This strategic focus is expected to drive sustainable growth and maintain ABM's competitive edge in the market.
Key takeaways. In summary, ABM delivered solid revenue growth and maintained a strong market position despite a slight EPS miss. The company's strategic initiatives and reaffirmed full-year outlook suggest a positive trajectory. Thank you for joining us, John.
Thank you for having me. It's been a pleasure discussing ABM's performance.
Thank you for watching Smart Stock Watch. Don't forget to like, share, and subscribe for more financial insights. We'd love to hear your thoughts on ABM's performance in the comments below. Until next time.